to the rules of professional conduct. And in this class, we'll be speaking practically to professional responsibility and liability, looking at chapter 4. We are less than 90 days to exams, 80-something days if you want to count down. We have to double up. I met one of us today physically in Kano, and he was suggesting we double up the class to maybe Tuesdays, Mondays, Mondays, Thursdays, and Saturdays. So we could double up. We have about 16 chapters, and in less than 90 days, we have just covered 4 chapters because of the question and answer sessions that are taking our time. So we would see how to integrate that Mondays, Thursdays, and Saturdays if it will help us catch up with speed, if our speed will double or increase due to that suggestion. So we'll bring it to the fore and we'll bring it to the class as we move on to see how to cover up our class. All right, so today we are looking at professional responsibility and liability, speaking to chapter 4 of the AAA subject. The content, as you can see on my screen, we have 5 units, including the chapter review. We have the first unit speaking to the auditor's liability and the expectation gap. And the second unit will be looking at fraud and error, speaking to the international standards on auditing 240. And the third unit will be looking at the auditor's liability, and the final unit will be managing the auditor's liability. And the fifth and the final will speak to the chapter review. I'll be running, but then don't forget it's a democratic class, it's an interactive class. Your engagement will be appreciated. As much as we want to run fast and move to the past questions, if you have any concerns, any thoughts, any contributions, observations, please interject freely. Use your hand key and stop me, and let's clarify and provide context to any of your concerns. So let's look at the first unit, speaking to the auditor's liability and the expectations gap. And this unit will be looking at 4 sections. We'll introduce the unit, we'll speak to the audit expectations gap, then we'll close the expectation gap, then we'll speak about the IA International Audit and Assurance Standards Board question and answer, speaking to professional skepticism in the audit of financial statements. All right, so let's introduce section 1. You will see that this chapter generally deals with a number of aspects of laws and regulations under which auditors may have penalties imposed on them for criminal offense, or may have legal claims made against them for damages or negligence. So auditors are liable. That's what this session is saying. Auditors are liable. We are liable where we are criminally what's the word to use now? In context, if we are found guilty, we could be criminally charged as auditors. And we could also be charged for negligence of duty, where a company crashes or based on our duty of care, we fall short of any of those. Companies may claim damages on external audit firms, on audit partners, on those they've engaged to carry out audits. And that's why this topic is very critical in practice and in also passing the exams of the AAA. So take note of it. The potential liability of auditors have become an important topic in recent years. If you look at countries like the UK, the US, where there are corporate crashes or issues with companies, you see they go after the auditors, the audit firm. And where there are significant issues, they are fined. Some are even to the point of withdrawing their licenses to practice as chartered accountants or auditors. Some are fined, and some even go to jail for conniving with management and concealing a lot of issues, depending on the conviction in the court of law. So the liability of auditors in recent times is gradually growing. There are several cases online where firms, the big four firms, most of their partners are penalized after investigations are carried out by either the Public Complaint Oversight Board or the FCA in the UK, talking about the body that regulates or provides oversight, like the Financial Reporting Council. They go after firms when companies crash or companies have issues, and the auditors, if culpable, are liable for any damages, and most of them are fined. So let's take note of that. And the explanation put forward is that a high number of legal actions against auditors speaks to the expectation gap. So where issues of fraud have been concealed, and naturally external audits are supposed to bring them out secondarily, but are not brought out. That's the expectation of auditors. There is a gap in that area. That is what it means. So a number of legal actions against auditors speaks to the expectation gap. We are expected to pinpoint fraud secondarily. Primarily, the responsibility of fraud and error is charged with management. But as the third line of defense, where the external and the internal auditors are domiciled in the Institute of Internal Auditors 3 lines model, we are supposed to at least secondarily, if management did not pinpoint or provide context to any fraudulent activity, when it comes to the audit of financial statements and our duties, in the line of duty and our audits, we should be able to come across such significant areas, because third parties and external reviewers, external oversight providers like FRCN, the Public Complaint Oversight Board, those in the UK and the US, when they come after auditors or come after the report and find significant issues that will have been pointed out by auditors, then the expectation gap comes to bear graphically. So that's generally what expectation gap means. You are expected to detect 1 or 2 issues if primarily management have failed in that duty, and where the auditors also fail, then there is a gap. There is a gap because naturally it is expected that auditors would find out those issues and bring them to the fore. This is very, very important. So let's take note of that, speaking to what the expectation gap is all about. So just generally the introduction of this chapter. So what is the audit expectation gap? The expectation gap is the difference between what the users of the financial statements and members of the public think that the auditors should do. And it also means what the auditors actually are required by law and the profession to do. So take note of that. The expectation gap is the difference between what the users of the financial statements and other members of the public think that auditors should do, and also what the auditors are actually required by law and the profession to do. So the public may think auditors are primarily charged with the responsibility of detecting fraud and error. No. The profession requires us or requires management to be primarily responsible, but in the line of duty, when we are providing our service, doing our reviews, when we come across errors, fraud, after substantive analytical procedures have been performed, we should be able to detect secondarily that these are fraudulent transactions. So generally, the expectation gaps is the difference between what users of financial statement expect auditors and what actually the law expects us to do. So there are 3 main expectations or elements in the expectation gap. Number 1, the standards gap. It occurs because a perception that auditing standards are more prescriptive than they actually are, and that auditors have wide-ranging rules that they must follow. So the standard gap is that there is a perception, and the perception is that the auditing standards are more of paperwork and they may not be practical in real life. So there's a standard gap that is perceived by the general public. So we also have the rules that must be followed, speaking to the standards gap. Then we have also the performance gap that occurs because a perception that auditors or audit work has fallen below the required standards. There's also a performance gap. So the expectation gap is expanding, speaking to standards gap and also performance gap. So the standard gap, like we said, occurs because there's a perception that standards are more of prescription and they are not applicable to practice. And also the performance gap speaks to the perception that audit work have fallen below the standard or the benchmark provided by the ISAs. Then we have the liability gap, and it arises from a lack of understanding about the auditor's liability and who the auditor may be liable to. So three of them are very important. We take note of the standards gap, the performance gap, then the liability gap. So there is a perception that auditors have a responsibility for detecting all fraud, like I said initially, whether it occurs or not. And the consequences of this expectation gap includes high rate of litigation, suing auditors due to the perceived negligence of auditors, especially in developed world. When something happens, they go to court, unlike our part in the developing countries. So these high rates of litigation due to perceived negligence, high levels of expectation about what auditors should do, what they should not do, may lead to legal action against auditors if that expectation is not met. The issue of litigations are a bit lower from this part of our jurisdiction, but in developed countries is a bit higher. Speaking to incorrect decisions by users of audit reports who base such decisions on incorrect premises. So, for example, primarily stating that auditors have the responsibilities to detect fraud and error. No. Secondarily, we could, but primarily is the job of management. So this misconception needs to be put in proper context. Then also an increase in mutual distrust between the auditing profession and users of audit reports are also issues or consequences of the expectation gap. Because when there are corporate crashes or issues with companies after audited reports have been issued, you'll see that there is distrust that the auditors may connive with management to conceal a lot of things. And these issues needs to be resolved amicably. So the audit expectation gap, speaking to the standards gap, performance gap, and liability gap, is what brought about professional responsibility and liability, and how auditors could navigate these issues seamlessly. We need to be careful in practice to be able to bridge these gaps, and also align to ensure the public trust. This is very, very important. All right, so that ends the audit expectation gap. And if you have any questions, I'll be running. Please go ahead and interject very freely. So how do we close these gaps is the next section we'll be looking at. Section 3 under Unit 1 is closing the expectation gaps we just spoke to. Auditors need to improve public understanding of audit processes, and this will enhance the auditor's report. So understanding is key. And when the public and also management and every stakeholder understands what audit processes and the laws permeating around this is, then the audit reports will be received without any apprehension. So we need to improve the public's understanding on the audit process. And that is why from the engagement letter, the terms and the purview of where the audit covers should be stated explicitly. And from the initial engagement meeting with management, they need to be aware, the audit committee and those charged with governance that will be in that meeting need to be aware and understand that this is what we are supposed to do. This is what management is supposed to do. So understanding is very important. And communication, education of the public in terms of those charged with governance would improve this area. And the second way to close the expectation gap is strong controls over the profession. Like we have the international standards on auditing, and we have oversight bodies. Like I said, if FRCN could provide strong controls over these areas to close the expectation gap. The Financial Reporting Council, for example, in Nigeria and that of UK, look at audit firms, the quality, the performance, the reporting, and how thorough the job have been done. So these strong controls are provided by these oversight bodies to help enhance the quality of our audit reports. This is very, very important. So in doing that, they would bridge or close the expectation gap very, very seamlessly. Pardon me, just trying to sort out the power issue. So I spoke about improving public's understanding and also the strong controls that could be provided by oversight bodies. For example, the FRCN could close these expectation gaps on several issues around that. Then the fourth one is the guidance for auditors and management, speaking to going concern challenges. Responsibilities of management, responsibilities of auditors should be clearly stated. And auditors should take note of going concern challenges as our reviews are done. You're not just providing an opinion, look at the foreseeable continuity of that company. So the guide for auditors and management, a company is supposed to be a going concern, not just a year-to-year thing, but in perpetuity. So there should be guidance on how issues of going concerns are brought to the fore, resolved by management as depicted by auditors. Also, open communication between auditors and management and also the audit committee will help close this gap. Open, clear communication that will facilitate understanding of each party's responsibility and how to perform those responsibilities very seamlessly is key. Also, clear communications on the roles and responsibilities in the report will close this gap. Clear responsibility, clear communications of the roles and responsibilities of every party. Also, collaborative efforts to deter and detect fraud. Primarily, the job is with management, but then every staff is responsible for fraud detection, fraud communication in an organization. When we do fraud awareness campaign internally as an organization, I hear my former bosses and those that are on the audit committee saying, if you see something, you say something. So every effort to deter and detect fraud is the responsibility of every staff, not just internal control, compliance, risk, internal audit, external audit, but the collaborative effort of every team member. Then success varies by region, looking at UK, US, Africa. The audit committee actually plays a vital role. So across regions, looking at current trends and how the public oversight board in the US, then the FRCN in the UK are tackling audit firms, at least to provide public trust where companies are crashing. There have been considerate success and also reprimands where necessary when audit or there are audit failures. So the audit committee is a very important committee amongst other committees on the board that plays a vital role in closing this expectation gap. This is very, very key. So these points are very important. We take note of in closing the expectation gaps that we've spoken about in section 1 and section 2. So let's look at the final section on the International Audit and Assurance Standards Board, speaking to professional skepticism in the audit of financial statements. Professional skepticism is the inquiring mind, questioning mind, your alertness to something could go wrong. misstatement conditions, critical assessment of whatever evidence you are assessing. So financial statements are provided to you. You cannot take them hook, line, and sinker or at face value. You have to, in your mind, think of where it could be padded. That's what professional skepticism means. And in audit, this is a very important quality, a very important factor in doing audits. You must be professionally skeptical. You're not cynical. You're just saying, what if something is wrong? I did not prepare these financial statements. I didn't come about these numbers. I have to be sure these numbers are correct. Revenue was provided to you, for example, of 20 billion. There have to be evidence. You have to have a lot of support, documents, and evidence to validate that 20 million actually was earned from the company. And that is professional skepticism. But taking 20 billion as revenue for the period at face value without providing necessary checks, where are the receipts? How was this revenue recognized? What services were provided? What line of products were sold? What services were sold? And backup evidence for all this shows your professional skepticism, questioning mind that culminates in gathering of evidence to validate the fact that 20 billion naira of revenue that was reported was actually recognized. So it's crucial for identifying risks and responding appropriately. So our professional skepticism as auditors is key. And the International Audit and Assurance Standard Board has said in the audit of financial statements, this factor is a critical quality of all auditors, to be able to question and gather appropriate evidence based on every area that the auditor is not clear about on the financial statements. Professional skepticism is integral to the auditor's skills and quality of work, and also in the sign-off of financial statements. We are to be influenced by the firm's culture, the leadership, the audit training, the experience should culminate in good quality training that produces auditors with skillful skepticism and also quality output from the reports that come by. So it's necessary throughout the audit process, from engagement to acceptance to risk assessment to actual analytical procedures and the job done, to the production of the opinion, that we take particular importance and provide a lot of time to assess fraud, look at complex judgment areas, estimates, going concerns, and related parties. If you have worked with the Big Four most of the times, you see that immediately they start an audit. For those of us that are in internal audits, the Big Four will send you fraud risk assessments with a questionnaire, long questionnaire, 1, 2, 3 pages, identifying areas of the internal audit, and you should answer whether anything has come to your attention during the course of your work. So they are paying particular attention and putting a lot of importance to the fraud areas of significant concerns, and you should answer it in writing. That's part of their evidence. So most audit firms that want to do well provide those fraud risk assessments and pay particular attention to them, because they could be material misstatements in those areas that affect financial statements audit. This is very important. Also, this is evidenced through discussions, documentations. Like I said, every audit we do with these firms, we always get fraud risk assessment with questionnaires, and we respond, and you sign it to say that this is what I know, this is what I've provided, this is what has come to my attention during my work as internal audit, that may help them or guide them in the audit of the financial statements. The internal audit work is not necessarily tied to only financial statements, but the external audits look at financial statements primarily. Also, regulators and governance bodies support our skeptical behavior. Auditor skeptical behavior is supported. If you have areas of concern, it must be cleared or clarified. And that's what skepticism is all about. When you are skeptical about something, it has to be justified. Management has to provide you with support. Let me use the word comfort. You have to be comforted. And comfort doesn't come by saying, no, you see, verbal, this, no. Your comfort must come from evidence, documented evidence. If you have an area of concern, I don't understand these estimates. How did you come up with these estimates? What are your evidence? What are your trajectory? What have you done in the past? Provide me with documents. That's being skeptical. So your skeptical behavior facilitates the audit and helps you to clarify gray areas. Clarify gray areas. This is very important. So professional skepticism, based on the International Audit and Assurance Standard Board, the Q&A sections, look at the study text based on what we just spoke to in this last section. There are questionnaires on questions you could come up with of financial statements. I would suggest you look at the study text. We didn't provide context to those questions, but we provided some of the major points on what is critical in your skepticism. So look at those questions and how the management could answer them. They are a bit detailed on the study text. We don't have much time on this platform to be able to read them one by one and analyze them. Time will fail us. I believe we already know we are behind schedules in our lectures, so we need to run fast. So in your private studies, use the videos to also read with the study text as we answer questions. Very important. These slides are a summary of what is in the study text, so it does not replace the study text. Please take note of that. You have to still read the study text. It's much more elaborate. This is more of summary and pocket notes. Let me use the word pocket notes. Okay, so that's the end of Unit 1. We just looked at the 3 units in Unit 1, speaking to the audit expectation gap and generally the auditor's liability, the general perception of the public, and the expectation gap. So do we have any questions so we can run to Unit 2? Any questions, observations, contributions? So we can move to Unit 2, speaking to fraud and error, International Standards on Auditing 240. Any questions? All right, I believe we are getting the concept. Our silence validates that. Okay, so let's move to Unit 2, speaking to fraud and error, ISA 240. And I noticed predominantly the questions that have came from this unit, even though I've not finished reviewing the questions, but then some of them came from this Unit 2, so pay attention. The sections we'll be looking at is the distinction between fraud and error. That's the first section under this unit. We'll also be looking at responsibilities of management and auditors for fraud and error. Who is primarily responsible? Who is secondarily responsible? We'll also look at the third unit, the auditor's procedures, where fraud and error is suspected. And we'll look at, finally, professional skepticism and fraud. So let's get to work. Okay, pardon me, my screen just froze now. Trying to toggle it and it's frozen. Okay, so it has responded. All right, so the distinction between fraud and error. What is fraud and what is error? So I would like somebody to help me with the difference between these two. It's on the screen, but what do you understand in your own words by fraud? We hear this word fraud, we hear error. It's there on the screen, but please provide context. What do you understand by fraud and error? Let's make it interactive a bit. Please, very critical area. Let's understand our perspective. What do you understand by the word fraud and error? Just share freely your thoughts. Don't worry. You may not read what is on the screen verbatim on the slides. Just share. What do you understand by fraud? And you could state what's the difference. Okay, AA, please go ahead. Thank you. I can see your hand. Please go ahead, please.
Good evening, sir. Can you hear me clearly?
Good evening. Yes, we can hear you, even though you're not loud, but please go ahead. We can hear you.
Oh, okay. So, to me, fraud is an intentional act, like a deliberate act to purposely let me say, do harm to the financial report statement. To purposely siphon money and all that of a company, while error is a mistake. Hello?
Yes, I can hear you. It's
Can
a
you hear me?
mistake, you said. Yes, we can hear you.
Okay, yes. Error is not deliberate, it's unintentional. But the impact between the two is always the same
Fantastic.
on the financial
Fantastic.
statement.
Fantastic. Thank you very much for those thoughts. And I think I agree absolutely. Anybody with a differing opinion, thank you, AA, for that. Any person, any other ACA with a differing opinion, I think I agree with her. One is intentional, one is unintentional. Any other opinion? Anybody wants to share?
Yes, sir. I think for fraud is something that is willful acts by an individual to defraud a company or a firm where he works. Then for error is something that is not intentional to say, or it's not. It's an act that is, not willful, so to speak.
Yes.
So it's like a mistake. It comes in as a result of maybe mistake or oversight or something like that.
Exactly. I agree absolutely. Thank you so much. I agree with the two speakers. Speaking to fraud, it's very clear. Fraud is when somebody intentionally does something wrong in the financial statement to deceive others. Simple. AA put it simply. Hassan also put it simply. For example, a manager deliberately inflates revenue so that profit looks bigger. So the key word in fraud is intentionality. It's done on purpose. Take note of that. Then for error is something that happens in the financial statements by mistake without the intending plan to mislead, intention to mislead, which is correctly stated by the two speakers. So, for example, an accountant wrongly adds numbers because of carelessness. He adds numbers carelessly, maybe from the Excel formula or something, package, the spreadsheet. So, error is unintentional and is by accident. But the impact, both for fraud and error, leads to misstatements in financial statements, which means users, investors, regulators, management may make or might make wrong decisions because the information is not accurate. So fraud is more serious because it involves deliberate deception and usually signals weak internal controls or poor ethical tone at the top. So in summary, from what our two speakers have said, fraud is intentional misstatement, error is unintentional misstatement, but then the impact is of both is misleading financial statements, wrong decisions, loss of trust, reputational and financial damage. Yes, please. I saw KU's hand flash. Sorry, please go ahead. You wanted to share some thoughts. Please go ahead, KU.
Yeah, good evening, all.
Yeah, good evening. Even though your voice is faint, it's low.
Oh. How about now? Is it okay now?
Yes. I think it's getting clearer and louder. Yeah, KU, please go ahead. We can hear you. We can't hear you again. No? I don't know if somebody is hearing him.
Hello.
Yes,
Hello.
please.
Can you hear me?
Hi. Yes,
sorry,
we can hear you now.
The network is really fluctuating. I'm sorry about that.
Oh, apologies too about that. Yeah.
Yeah. I want to look at the motive as a differentiating factor in fraud and error.
The
fraud
motive
is basically
like
to
word.
gain an unjust, to gain an unjust or illegal advantage, especially financial gain or some personal benefits. Error, there is nothing behind error because it's purely a mistake. Because we are human, we can, we are subject to mistakes here and there. So that is speaking to the motive behind the two. And then we also need to look at the legal ramifications. Meeting each of these, where can it lead us to? Or what can be the talking about fraud, it can lead us to criminal prosecutions. At times, fines can be imposed, can be paid, and even to imprisonment,
Exactly.
Because it is a legal offense. But speaking to error, errors somewhat can be subject to, it depends on the management. Management can forgive, or they can also dish out a minimal kind of punishment just to deter the one, next time to be very careful not to commit errors. That's the area I want to look at, the motive and then the legal ramifications.
Exactly. Thank you very much for those thoughts, and they resonate practically, and I agree with you. The motive, then the effect, the impact. Most of the time you see cases, like you said, management or the board may decide for fraud and error. The decision for fraud may be very stringent, could lead to imprisonment, but that of error may be minimal. But then punitive measures must be provided to ensure that they deter. So I agree with his thoughts. Thank you for bringing that to the fore. That's a good perspective. So the study text is clear. Fraud is intentional and error are unintentional, and you could see areas where this could permeate. So the key difference, like we said, is the intent. But the impact on the audit can be similar. It's not different. The impact of fraud and error is the same. So reporting requirements also may differ. So that's generally the distinction between fraud and error. And we've spoken, all the three speakers have spoken well and comprehensively on this matter. So section 2 speaks to responsibility of management and auditors for fraud and error. So management primarily are charged with the responsibility of preventing fraud or detecting error, providing the true and fair view primarily first, and also the internal controls. So the responsibility is charged primarily with management. And management is responsible for anything that goes wrong in the financial statement as a result of fraud and error, while the auditor obtains reasonable assurance that these financial statements are free from material misstatements due to fraud and error. So the primary responsibility is with management, while auditors will provide reasonable assurance. And where auditors cannot provide reasonable assurance, they have to state the material misstatements due to fraud and error. So secondarily, auditors are also liable where it is clear that there are material misstatements due to fraud and error and is not pointed out. So we must understand this, and questions have come around this area where some candidates even write that auditors are primarily responsible for fraud and error. No, auditors should obtain reasonable assurance that the financial statements, reasonable assurance is not absolute. Please take note of these words. Assurance can never be absolute, but reasonably, that somebody will read the financial statements and from the numbers will be like, how come the auditors did not see this? How come? Or maybe there's a peer review, another audit firm looks at what another or the preceding audit firm has audited and be like, how come these numbers and these statements, the auditors didn't see it? So there should be reasonable assurance that the financial statements are free from material misstatements due to fraud and error. And that is the job of the auditors, primarily, to provide assurance. And also that of management or those charged with governance is their primary responsibility to do that. So it's not the primary responsibility of the auditors to prevent or detect all fraud, because we have inherent limitations that some of these issues may go undetected. The auditors are not the primary producers of those reports. Take note of that. So it's not their primary responsibilities, but from audit procedures, analytical reviews, and testings that have gone, auditors could detect it secondarily. So we need to provide and understand this context to which the responsibilities of management and auditors are comprehensively understood. So let's decipher that and know that there are reasonable areas where, of course, auditors are liable, because if peer reviews and oversight bodies come, they could detect the fraud and be like, how comes the auditors did not find this, did not see what we are seeing? And it could mean collusion with management to conceal a lot of things. So that reasonable assurance should be provided with evidence. But primarily, it is with the job of management to ensure that prevention and detection of fraud by installation of good internal controls are in place. And that is why ICFR has come to add value. The internal control over financial reporting has come also to add value to this conversation. Okay, so let's look at section 3 if we don't have any questions, and we've spoken graphically to section 2 on the issue of fraud and error. The auditor's procedures where fraud or error is expected. Auditors need to perform procedures. If you suspect fraud, you are skeptical about some numbers, some names of the financial statements, audit procedures should go on. You should take note of such areas and be clear. So you need to identify if there's a suspicion of fraud or error. You need to identify the extent and the impact. Is the fraud materially huge in terms of value? Materially huge. The extent and the impact, or the procedures that will be performed, will be determined by the value or the materiality of those skeptical areas auditors are assessing. And we need to also document them very practically. Gather your evidence, because it has to be appropriate and sufficient evidence. So identification first, the extent and the impact, then also documenting is very important. Consider impact on other audit areas and the risk assessment you've performed. So if areas of the financial statements as the auditor is skeptical about, then there may need to be a revision of the audit plan to consider those high risk areas. Very important. So in the internal audit and the external audits, the plan should focus on high risk areas and also areas in the financial statements that could be materially misstated. So during risk assessment and looking at the financial statement generally, the auditors need to understand the extent and the areas that may be impacted by these high risk or fraud and error prone components of the financial statement. And also we need to discuss with management extensively on these findings, and procedures need to be performed appropriately. Don't forget, auditors are also liable based on the audit expectation gap. So if these areas slip under us, then we are liable. How come you didn't see it is the question. Like one of the former CBN governors, when most of the banks were crashing, they were asking, where are the auditors? Where are the auditors? So that's the question the public will ask. So we also need to keep management informed and also determine management's action. If management action is not appropriate, we need to get legal advice, especially where the fraud is material. This is what I'm saying. You speak to your legal team. What do we do? This is what we've come across during our work. How do we go about it? This is how management is taking it. They are not taking it seriously. Do we report it to regulatory authorities? Do we report it to the board? Do we report it to the owners of the company? So you need to determine management action. If management is taking it seriously, depending on the materiality, then it's fine. But where it's intentional, maybe it's a collision between management to conceal those things, then the legal advice is very important for auditors. You need to communicate formally also with management, the board, and the audit committee. So where it's brought to the fore to management, nothing is done. You move to the audit committee, nothing is done. You move to the board, proper board, nothing is done. Then you can move to external regulatory authorities to report. So the escalation points matters in your communication at each point to get that level of comfort that you've done your job as the auditor. In a point or to a point where management has displayed gross irresponsibility and lack of integrity, then legal action, resignation could be the course of action as an auditor. Where management has been obstinate and they've shown gross lack of integrity, then the audit team may need to resign from that engagement, because there are high-profile fraud where even management are involved, and where auditors have read between the lines that management are not ready to do anything about it. Then resignation could be the final course of action for auditors, because you need to consider your reputation and also consider what will be published in the dailies when the FRCN and other oversight bodies come after those audit firms. Because the impact of the audit report, if it's not providing a true and fair view, then you need to consider resignation if management is involved. So consider also reporting, like I said, to authorities within the confidentiality purview, which is our duty. So discreetly, you need to be able to report to management on these issues. So that speaks to the auditor's procedure where fraud and error is suspected, what to do, how to go about it, and necessarily how to ensure that the auditors are liable and safeguards and mitigants are there in doing our duties. Very important. Okay, so that speaks to section 3. So let's look at professional skepticism and fraud. I think that will be the final section under this unit. Auditors need to maintain suitable skepticism, the inquiring mind, the questioning mind. Discuss fraud possibility with the audit team. Speak to internal audits. Like I said, it's one of the areas the Big Four don't take lightly. They send you fraud risk assessment even before the engagement. They ask you to fill the questionnaire. They have meetings with you. What are the areas of concern? They ask for your report. They ask for your fraud policy, your fraud investigation manual, just to have an overview of what could have gone wrong internally and could impact the financial statements. So as auditors, we need to be very skeptical. Discuss with the audit team, the internal audit team, and also your external audit team members on possibilities of fraud in doing the job. Discuss management's fraud prevention controls. What are the mitigants in place? Are the 3 lines of defense departments in that organization? Do they have the risk and compliance? Do they have internal control department? Do they have internal audits? Where these are not functional, then you know it's highly risky, because the production of the financial statements have not gone through any internal scrutiny. So the job of the auditors will increase. So these discussions around fraud prevention control should ensue before the engagement starts. An organization that has an appropriate second line of defense, risk, compliance, they have internal controls, they have internal audits separately. And the auditor's job has been done to some extent, because he will just review the reports. But where none of this is resident in that organization, then the audit job will be more Herculean. It will be elaborate. It will be more open, because a lot of mitigants are not in place. So those procedures have to be performed by the external audits to validate what is in the financial statements. So as auditors external, we need to identify fraud risk and also evaluate the impact. Look at the design procedures to obtain evidence about fraud occurrence. Where are the fraud reports? What are the evidence? What are the actual circumstances? Who are those involved? So these are areas of skepticism that auditors need to take note of and also question very pragmatically. So professional skepticism in the areas of fraud is key in the audit of financial statements. All right, so that ends Unit 2 on the issue of fraud and error. So Any question, contribution? And I would like us to look at this third unit before we go on break. We have 10 more minutes or 8 minutes to go on break. Any question on the unit 2 we just discussed? Contributions, observations? Okay, that shows we are comprehensively in line with what our conversation is. So we're looking at the auditor's liability. And this section speaks to the introduction. We'll look at criminal liability and civil liability. We'll speak to this in the next slides. And hopefully before 9, we should round this up. Okay, so like we said earlier, legal claims can be criminal on auditors or civil. Criminal claims or criminal prosecution for auditors could be where auditors have been found guilty of criminal activities. And criminal activities could speak to conniving with management to conceal or defraud the organization. And civil could also be for negligence. So like we said, or like some of us ACAs have opined on fraud and error, which is correct. Fraud is a criminal offense, is intentional, while civil is unintentional, but could result it could be as a result of negligence. And firms could claim for damages, and that is why auditors are liable. We have to be careful. We are either criminally liable or civilly liable. So legal claims made against auditors fall within one of these two legal strands, either criminal liability or civil liability. The auditor may be prosecuted by authorities for a criminal act and be criminally liable if found guilty. The penalty may be fine and possible imprisonment for a guilty individual. So where an auditor has connived with management to conceal information, has been provided with bribe, not to flag a lot of things, it could be liable. And he could also be liable under the civil law where he's negligent, he's not professionally capable, and he went to do the job and has brought loss and damage to that company or the individual he audited. He's civilly liable. And that is why professional competence is very important in doing a job. It's better to resign or decline a job than to go into something you don't know anything about, because you'll be civilly liable that, I didn't know. I didn't know is not tenable in the face of the law. So you have to know, and you have to appropriately know what you are doing. This is very key. So the person bringing the legal action usually seeks money payment, provide monetary value for damages done to the organization from the auditor to recover their losses they have suffered. So where a company has crashed and auditors have been paid their fees, audit fees, and the auditor's duty has not been performed, he's civilly liable, or it has been performed but not up to standard, or there are negligent areas that were found that the auditors were supposed to have flagged. Then monetary payments will be asked of the auditor in form of fines and penalties. So auditors could suffer this, and clients, companies who want to recover the losses they suffered. So the precise details about the auditor's criminal and civil liabilities vary from countries to jurisdiction, depending on the national legislation. In the UK and the US is very stringent, and currently in Nigeria, the FRCN is not taking it lightly also with auditors. We've seen where last year some audit firms, the partners were suspended publicly. Their licenses were seized last year. I won't mention the name of the firms, but partners were brought on the dailies for negligence, professional negligence, not outright fraud, civil liability. So it depends on the jurisdiction and the country. So as candidates, we need to maybe look at business law and the section that addresses areas of the Nigerian law to have a glimpse of what the liability in the area of criminal liability, civil liability for auditors is. Just one 2 hours view of the business law and where auditors are liable in this, I think, is a foundation subject, business law, speaking to business law. We can just go back to that. The study text is there freely for us to go through. Okay, so that's generally the introduction to the auditor's liability. So speaking to criminal liability, examples of where an auditor may be criminally liable includes where he accepts appointment as an auditor under a statutory position without being qualified to act. So there are qualifications to act as an external auditor. So an auditor is criminally liable, number one, if he's not a chartered accountant, he went to accept the job. If he's also a chartered accountant, he does requisite experience to act as external auditors, he's criminally liable. Because I am a chartered accountant, but I don't have the experience to do external audit based on ICAN's guide, ICAN's law. So where I do an external audit and sign with my membership number, something goes wrong with that organization or another review is done, I am criminally liable. Because under ICAN, I cannot do external audits. Audit firms should do external audits. I'm a chartered accountant, of course. That notwithstanding, I don't have the requisite experience. I don't have the requisite permission or statutory provision of ICAN to carry out external audits. So I am criminally liable if I do that. So at no point will somebody come and say, oh, you are a chartered accountant, can you come and do us external audits? I'll tell you, no, I don't have a firm. I'm experienced in that area, so I cannot do it. So that qualification to act in that capacity is necessary to avoid criminal liability. Very important. So take note of it. Where also an auditor is involved in fraud, such as falsifying accounting documents or records, somebody is criminally liable. An accountant or an auditor could also be liable where he's guilty of insider trading. Insider trading is having privilege in information and using it for yourself, for your advantage. For example, the company wants to sell shares, you just go and meet your wife, or you go and buy it in another name. If you are found guilty, is a criminal offense. That's insider dealing. So the criminal law of many countries makes it an offense for a person with inside knowledge of maybe price-sensitive information to use or pass it on to somebody that will gain advantage with that. Insider dealing is prohibited under IFAC and ICAN's rules. Very important. Insider dealing is prohibited. Let's take note of that. Also, civil liability. Negligent auditing can lead to claims under contract law and the law of tort. And that is why we need to look at business law to understand contract law and the law of tort. Contract law speaks to a company can sue an auditor for breach of contract, speaking to negligence. Only the company has that standing. And that contract states that within the purview of the terms of reference of the contract, if there's any breach, the auditor is liable. So he can be sued under the contract law. If there's any breach of that contract, the auditor is liable. The auditor's duty of care and performance of that contract is very important. So we need to exercise reasonable care, be diligent, understand companies, our CAMA Act, the updated 2020. We need to follow the auditing standards to ensure that we perform our duty based on the contract. So where an auditor is following this standard, he's defending himself, providing mitigants and ensuring his job is done appropriately with that necessary quality. This is very important. An auditor is also liable in tort, where third parties speaking to banks, creditors, shareholders, potential acquirers, without a contract must use the law of tort. So a successful claim in law of tort speaks to the fact that where auditors are liable, the law of tort, you read it in that business law, we provide a guide on how auditors should be prosecuted civilly. So to avoid this, auditors need to be careful. We have a duty of care. The auditor, as a plaintiff, speaking to a complex situation, has to be careful, get advice, speak to your lawyers, get professional advice before you take actions that could be detrimental to the profession, to yourself, to your firm, and to your practice. Also, breach of duty. The auditor did not exercise reasonable care during the job. Expert witness are often used against such auditors. For example, the FRCN sent for a peer review, and they found out that the exercise of due care based on the peer review that has been done on those financial statements, the auditor is liable. So the auditor needs to be careful. Then loss or damage, speaking to an auditor that is sued by a plaintiff, he could suffer loss due to negligence. And where there are no clear terms provided, the establishment of the duty of care provided in the law of tort, we need to provide a lot of mitigants to avoid these as auditors. So there are cases in the study text that would, if you read, will resonate with you. Speaking to some of them on the screen, Hadley, Bryan, and Keller Partners in 1964 speaks to the fact that the duty owed to third parties known by name who relied on the auditor's work was brought to the fore in that case. Jeff Fastins and Mark Bloom's 1980, the duty owed was but to no liability, as the plaintiff, the person that sued the auditor, would have proceeded anyway. So read the details of these cases. Caparo Industry and Dickman, a leading case also, speaking to out-of-court settlements where cases are withdrawn by plaintiffs. You understand them in the study text. So out-of-court settlements are better for auditors because they save time, costs, avoid negative publicity for the auditors, potentially lower settlements, and the disadvantage of out-of-court settlements could be unclear legal position and may discourage claims where the maybe primary intent of the client is to get money, and also insurance costs could be, but it's advantageous for auditors to accept out-of-court settlements to avoid reputation risk. Also in reporting, one of the mitigants auditors will use is the use of disclaimers. Statement in auditor's report limiting the liability of the company and the shareholders, and disclaimer of opinion is important. The purpose is to reduce third-party claims. It's not actually a guarantee of protection, but at least it will reduce the impact of any suing of the audit firm by the external or the clients of that audit. So this is very important we understand for criminal liability and civil liability. Still go through the study text with these slides as we provide, as we look at practical areas on how context was provided to this subject. All right, that will be the end of Unit 3. And this will be the last unit, speaking to managing the auditor's liability. I added extra 5 minutes, I beg your pardon. So let's go on the 10 minutes break. We've been on a long hour discussion. Let's stop here, go on